lazy the banks are in this country.
She would sleep on the couch so we would be able to have our own bed.
That you have people that you can lean on, business partners that you can trust. So I'm Roy.
I'm Ali.
Hey Ali, before we get into it, let's share with our listeners why we started this podcast. We've been wanting to do this for a little while. It's been on and off, one of those projects, and we decided we're finally going to make it happen. We invested a little bit of money, put some time aside, and we're going to make this happen this year. So we're committing, we're doing this, we're making it happen, right? Yeah. Let's talk about why did we start this podcast, and why did we call it Property Matters, and then we'll get into today's topic as well.
Awesome. All right. Okay. Yeah, I think we've obviously have been busy probably the last 1 to 2 years with everything that we've got going on. Full disclosure to everybody out there, myself and Roy are business partners. We both run a buyer's agency business called Buyers Club. Roy runs our Victoria office. I run our New South Wales office. So I guess we've been busy doing that. But we've been talking about setting up a podcast for some time. And I think, I guess the reason that we wanted to kind of set it up has always been to share our story, to educate people on what to do, especially people from our community as well, where there's a lot of different ideas and values that are probably a little bit misguided, right? They're not up to date with currently where the market is at the moment, or what you can kind of do in today's day. But I guess the main reason why we wanted to create a podcast called Property Matters was essentially we wanted to help everybody understand the real advantage and the importance of property investing, right? Like to touch on where I got into property investing, which started really now 11 years ago. Started the first day of university. I did a Bachelor of Property and Economics, and I remember coming from a housing commission, single family, single parent household. I remember the university lecturer, the first thing he ever said to the hall was, for investment, you don't have to be rich to invest, but if you want to be rich, you must invest. And over time, obviously, what rich means to different people and creating wealth is a different story for every person. And each one of us have our own individual and special story. But Property Matters and the podcast that we're going to create is going to be purely to help each person understand what they can do, but also understand the value of property and how to use it for our own and personal benefit. Okay? The information that we're going to provide is going to be real life information that we do. There's not going to be an agenda behind pitching a specific location. There isn't a hotspot market. There isn't a one size fits all strategy. It is purely going to take you on the journey of both myself and Roy, who we are both at different stages of our property investing journey, but also educate you guys on some of the pitfalls and the mistakes that we have also experienced, investing in property. We're also going to touch on what it is like as, again, different type of people and personalities. Myself, I'm under 30. I'm just recently married. I know Roy, you're a little bit above 30 at the moment. But
I'm 70.
Married with a kid, and I guess what that looks like in terms of how does the day-to-day go around actually with coincide with investing in property. So if you want to learn about how investors buy properties, how we help everyday Australians purchase properties, where we are technically buying, what are the different structures and pitfalls that you can avoid or learn about to help you grow your portfolio, then Property Matters is going to be the podcast for you. So we help everyday people get into the market. One of my goals is to help at least 100 people from my community, right? From my community, people growing up around where I've grown up, get into the property market for the first time. It is so expensive for a lot of people out there to buy a property in the area that we grew up in or around it, just because prices have gone up so much over the last 10 years that they need an alternative solution. They need to be able to invest into real estate without making the mistakes that other people get into, right? Education that they get to gain to help them and enable them to actually have the confidence to invest into property, but also look outside their backyard. And I think a big part of what we're going to touch on and a big part of what we see every day is that people can no longer afford their backyard, especially here in Sydney. So where else can they purchase and what should they be buying is what we're going to educate people about, but really just get, along for the journey, along for people that want to listen, talk about, everything got to do with property, but also, some other things on the side as well. Talk about family, talk about relationships, talk about goals, talk about adversity, talk about shit things that happen, everything that, comes with it. Property isn't it's not a smooth transaction every single time. It's not a smooth ride, but there's a lot to it. And I would say that, 50% of it is property and buying. And I think 50% of it is mindset. So if you want to, be here to talk about mindset and realness, stay tuned.
Speaking of mindset, Ali, I never asked you this question before. How would you say your childhood experiences? You mentioned earlier you grew up in housing commission, had a single mom. How would you say your childhood experiences shaped the man you are today? Your passion, your drive, your motivation, etc. How would you say that has that impacted you?
Oh, I think it impacted me in different ways, kind of growing up, truth be told. When I was younger, I was probably a little bit more of a rugrat and got into a lot of trouble. Probably caused my mum a lot of pain, a lot of frustration growing up. But, one thing it really made me want is a desire to be able to look after my family. How that shaped my future was just knowing that I had to be extremely driven, knowing that I had to pick, or really deep dive on one specific thing that worked well. It made me really patient, I guess, in what I wanted to do, but it also made me extremely obsessed with trying to, I guess, get out of the scenario that we lived in, right? We lived in you could call it a 3-bedroom unit. It was a housing unit. It was probably around 70 square meters. There was 6 of us living at the time. I remember even my mum, she was such a beautiful person where she'd sacrifice a lot, where she would sleep on the couch so we would be able to have our own bed, right? So, that was something that, even till today, when I've actually bought her own home, she still finds a reason to sleep on the couch. I think it's just part of her nature because, for 20 years, we kind of lived that way. It took a while, but it taught me a lot about delayed gratification. It taught me a little bit about needing to get outside of my comfort zone, do something different than what I've just been told, because there wasn't the same opportunities, 10 years ago than there was 20 years ago. Vice versa, there's not the same opportunities now. So it just made me really driven to want to really help other people. And other people for me was my family, my brother, my sister, my mum. So that made me extremely, extremely driven. And I think ever since then, I've just kept that drive. Now, money, to be fair, isn't probably the drive as much anymore. Thankfully, I've invested into real estate. It's definitely improved my position. But the drive is still there to, I guess, help others and change lives. Now, I'm not I'm not here to kind of save everybody. I'm just here to more educate people that it takes time. It can be hard, but knowing and following a process actually does work. So I think that's, been the biggest impact for me, just, being able to switch on, head down, do what I know I need to do, and just accept the fact that it's going to take time.
Yeah, my experience has been a little bit different. As you know, I migrated here in 2012, and I started working in real estate in 2013. I have childhood memories of my dad taking us for a cruise in his American Buick car, that would break down every second day. And he wouldn't have a lot of money, but he would still take us for a drive, get us ice cream and so forth. And I remember being in a private school because my dad was very passionate about education. And every once in a while, the principal would pull me out of line while we were going to class, and she'd say, hey, your fees are due. Your fees are due. And mind you, I was a kid. I was like maybe 11 or 12 years old, and she'd put me on the spot. And eventually my dad got the shit and went to school, crackers, I stopped talking to my son, blah, blah, blah. But it left a mark in me. It left a mark in me that at some point I have a little bit of anger that my dad fell short in some situations, that he didn't really scale the way he was able to scale. But it also taught me the importance, to be fair, it taught me the importance of, if you run your own business, it's very, very important that you have people that you can lean on, business partners that you can trust, and people to have your back. You can't go too far on your own. And it's something that's just ingrained in me ever since I was a kid, because I have an old man who's never worked with anyone else by himself, never really hired anyone, has done everything himself, and it got him so far, right? And then at some point we paid for it, we paid the price as a family. And then obviously I came here in 2012, started buying real estate in 2013, 2014, and here we are today. So very excited to be obviously doing this podcast with you. So let's just now, this is a bit of a recap about us guys, who we are. This is a new podcast, so we're also finding ourselves in this podcast, to be fair. So if you have any suggestions, if you'd like us to do anything different, if you'd like us to interview specific people, have any special guests, feel free to mention them in the comments below, or let us know your thoughts about what we're doing. And we'd love to make sure that we're just putting out content that's not only beneficial, but also inspiring for you guys. Because they do say you are the average of the 5 people you hang out the most with. So just assume that you can hang out with us for an hour or two every week or two. And we hope that you can get some value. So let's get into it today. The buzzword, a couple of things that Ali and I want to talk to you about today. Interest rates. And everyone under the sun today is talking about capital gains tax changes. My son came from childcare the other day. He's 5 years old, and he's almost talking to me about CGT changes. Everyone's talking about it. So we might as well just talk about it ourselves, give our 2 cents, and then just take it from there. So Ali, interest rates increased. They're sitting at 3.85% not long ago. How do we feel about it as property investors, as a company who's helping obviously clients invest in real estate? What are we seeing and how do we feel about it?
Yeah, it's a good question. So, you know, rates are obviously a very sensitive topic on whether it's a good time to be buying now, or whether it's not a good time to be buying now. And, you know, everyone goes back down to, you know, well, if rates change, it's either going to be good or bad. Where it's kind of, you know, really unusual to still, I think that way. And the main reason that I speak to people is because let's be realistic in saying, well, interest rates went up from 2022 13 times, right? But we saw some of the most amount of growth in 3 major capital cities than they've ever been. We saw record prices, so record prices being set for these capital cities out of an all-time, all history, where prices have gone up the most, or been the highest median price during 13 interest rate rises. Like, people keep thinking that interest rates are going to be the precursor for whether capital growth is going to happen. It is wrong. Now, in saying that, if interest rates go to 20, 30%, it's a completely different kettle of fish. But what I always talk about is, like, let's be realistic. You know, people talk about the GFC or 20 or 30%, 20% drops or 30% drops. Okay, I always say this, is that if a property was to drop by 30%, some of the biggest losers would not be individual mum and dad homeowners or investors like myself, right? It would be the banks. Like the banks, think of it this way, right? Somebody goes out there, gets a 90% loan, buys a property for $1 million. The market drops by 30%. That means they've got negative 20% equity. Property's worth only 700 grand, right? Okay, well, if they were, assuming most people would walk away from that, right? To pay for 200 grand, like only a handful of people would keep that property. So then the bank loses. Now, 200 grand for one person, that's a massive amount of money. But then think of it on the scale of a large bank, right, who's got hundreds, if not millions of loans, right? If they're losing $200,000 even over, 100,000 properties, that would be astronomical, right? And that's why the government never allows it. Banks will never really allow that thing to happen, right? There's obviously a lot of uncertainties in the market. I don't ever see that occurring. I think it's very unrealistic, especially now that we see governments doing things like 5% deposit schemes. They're backing property. They're supporting people to get into the market, right? Again, to touch on all of these things, it's about, well, if all these things are backing property and you've got much larger players at stake here, interest rates, right, are number one, not having such a significant impact, right? Number two, the kind of control of interest rates through monetary and fiscal policies, right? They adjust these things. Banks don't want to see people default on loans, right? It's not in their nature to do it. They're not private lenders in a sense where they're going to prey on the individual mum and dad to take their home and then sell it later, right? So with interest rates, I think you take them with a grain of salt. Obviously, interest rates have just gone up. Will they go up again? I think so, a little bit. I do predict that interest rates will come down towards the end of the year again, and they'll, I think, fluctuate around that kind of 3.2, 3.3% mark. I think we'll see normal rates between 5.5% to 6%, potentially lower interest rates for owner-occupiers. But at the moment, spending is somewhat maintained. We're just going to, again, that's just something that you take into consideration. From a property point of view, more and more properties are struggling to get that sort of, cash flow positive return that people are looking for. You've got to get a little bit more creative. I know there's a strong demand for those cash flow positive areas. I guess, those areas are really starting to see a lot of capital growth. If you see an area that's cash flow positive, chances are in 3 to 6 months' time, with the amount of, demand for those properties, they no longer become cash flow positive because prices push through quite a lot of activity. So, in saying that, what's going to happen? Is it going to affect property prices? My opinion, absolutely not. I think part of your strategy should be understand that interest rates don't affect property prices, and there are other fundamental issues that do, like affordability, like demand, supply factors that actually make more of an impact. But more importantly, interest rates should be so important for you to understand your cash flow, right? Can you hold a property if it's negatively geared? And that's where people need to test interest rates. Like people that got interest rates at 2-3% and built their portfolio based on that, right? I would say that's where people got affected the most, right? So testing your interest rates on decent numbers, good interest rate, buffers is probably the thing that most people need to look at. Doesn't affect property prices.
Yeah, and we do that, RBA. We do that for our clients in their strategy sessions. We get asked all the time, what happens if the rates go up? And like, yep, no worries. What do you think? They might go up to 7%. So we just chuck 7.5% interest rate, for example, or we lower the rental yield, and then they can see what their cash flows can look like. And then typically the reaction is like, oh, that's not too bad. We notice it all the time. I read an article a few years back speaking about banks. I can't remember. It was AFR. It spoke about how lazy the banks are in this country, in a sense where the majority of their income is just lending money out for real estate. And then real estate is available in this country, and it's not available in abundance. There's obviously an undersupply, a chronic undersupply of property. So what it's doing is it's creating an environment of young men and women who are not really aspiring to be very creative, to be fascinating at a specific skill set, or build amazing businesses, or just create something like they do in America, whether it's in tech or in science or whatever. And then anyone with a little bit of money is like, oh yeah, I'll just go buy real estate, sit on it for 10 years, and then I'll be sweet. I'm set. And the society is loving it, and so are the banks. So I think the capital growth is almost baked into our economy, with the expectation for capital growth. Don't get me wrong, I love that. I love the fact because we're also in the property market, so I have no complaints around that. But it's just very interesting to see that you don't see ads from lenders saying, hey, here's 50 grand to start your own business. You know, what do you need? Or a loan facility to scale your business. They talk about it a little bit, but just it's not the same as it is in other countries around the world, to be fair. So when I consider this, yeah, I don't think property market is going anywhere. Because like you said, it's not the mom and dad investors that are going to be missing out. It's the big institutional investors, like the lenders, like the corporations and so on, who are going to be missing out the most. And to be fair, the government, because the amount of money that they make on stamp duty is ridiculous, right? They keep saying they want to try and make property investment more accessible, but we don't really see that, do we? They just, it's like a morphine hit every 12 months or so. Come election time, come whatever, they just incentivize buyers somehow, and they just give them that morphine shot. Okay?
Yeah.
Now, the next big thing is CGT. Everyone's talking about CGT. I don't understand why everyone's talking about it. For me personally, I don't even buy in my personal name. I never cared about CGT because I never want to sell anyway. You know, it's like you just buy the real estate, you never sell, right? I'm happily buying properties under a trust or a company with no expectation for capital gain tax offsets and so forth. What are your thoughts about it? What are you hearing clients say?
Mate, you know, it's very interesting. I was reading something the other day where it talked about there's only 100,000 investors that own more than 2 or more properties, and there's only 12,000 investors in Australia that own more than 6 or more investment properties, right? So what the government is essentially saying is that, yes, we're going to reduce kind of capital gains so that they can free up a lot of these, I guess, investment properties, but or reduce people from having to be able to buy and sell to be able to kind of get it as a deduction. Mate, it always boggles me because you have all these government scenarios, and I know a lot of people that know property. We may not agree on many different things, but we all agree on one main thing, which is that, the problem isn't the investors buying properties. It is the government, right, doing everything but fixing the actual issue, which is the supply, which is the need for houses, the demand for houses, spending money on water services, infrastructure, migrants, and bringing people in that actually support construction, right, as opposed to other industries. And we can touch on the graph, which you'll probably see in this episode, where we talk about the houses that are needed to be built by 2029 and the government's target of 1.2 million homes, which we know they're currently not on track for, right? And that undersupply is going to continue to be strengthened over the next couple of years. So I guess property, depending on whether you're an investor or a first-time buyer, could either look very opportunistic or could look very bleak for you. In terms of capital gains, there's only a handful of I guess, investors that actually own 6 or more properties, right? That essentially, could be offloading a lot of property before the capital gains, ruling, if it was to come into account. Most people, like Roy mentioned, is that most of us investors that do own 6 or more properties, we don't own them under their personal name, right? Own them under companies, and we know that companies run a 25 to 30% tax rate. So again, you're pretty much getting relatively the same sort of tax now that if you were to buy it under your personal name. So most people would do that regardless. Companies also have other benefits, right? The biggest disadvantage to companies is that you don't get the capital gains discount. Now, you technically might be paying another 5% on top of it, which, in big scheme of things, most people are setting up companies anyway to buy properties under. So is it going to affect, is it going to make much of a difference? Absolutely not. It's like Roy mentioned, it's just another morphine hit that the government says to win votes, to kind of help, what they believe is the everyday Australian that's struggling to buy a home, caused by their own doing, right? By not building enough homes, by bringing migrants in to fund the baby boomers that will be retiring over the next 5 to 10 years, right? Because they didn't set up the supers the right way. They're not going to have enough for retirement. They need the migrants to come in. It is a domino effect of people are being brought into this country because they need people to be working and paying taxes, right? But are they allowing and supporting housing for these properties? Now, it's not just the government. At the same time as well, Australians have a very strong value to buy land, right? Buy land and houses, right? As opposed to buying, say, apartments. But just to, before I go off topic, capital gains isn't going to make much of a difference because, again, there's only so many investors that actually own a certain amount of properties in order for them to make a massive difference if they were to sell, right? In saying that it might create a little bit of a short-term supply, additional supply, which again might cause a little bit more affordability. But again, investors are also going to see the difference, right? If they know that their property is worth $1 million and they're on the market and they're getting it reduced by 50 to 100 grand, for example, because that's what it's supposed to do, create affordability, then and again, investors might not even sell because their capital gains might, not be worth what they're actually going to sell for, right? If they lose out. So, punishing the investor, I feel, is like a tall poppy syndrome that Australia has, right? Punish, people that are doing well or have a lot of assets. And it might sound controversial, but it's not the way to actually fix the problem, right? Most investors are, 60% of Australia's taxes comes from the construction industry. Who builds homes, new homes? Well, quite a lot of investors, right, for depreciation, deductions, and benefits, right? If they stop buying, well, the workforce stops, taxes stop getting paid, roads stop getting fixed. So many things.
Which industry was what was the first industry that government was to protect during COVID, when COVID hit? It's the construction.
Yep.
Right? Because they know for every $1 they spend in construction, they get $2 back. And we had the infamous home builder grant and so forth. Absolutely. You build a house, there's the people who are designing the house for you, they get the job. Then you have the builders, then the tradies, then obviously the government and the councils get their kick. But then what happens after you hand over a house? Then you buy furniture. Then the delivery driver has a job to deliver the furniture. Then you have to assemble the furniture, right? Then you get the cleaners. It creates a beautiful chain of just work for a lot of people that live in this country. It just goes unnoticed. And most people think, it's the greedy landlord. In reality, we meet them all the time. They're not greedy. They're just mom and dad investors who are really trying to set themselves up for the future and are willing to compromise a little bit and delay gratification, like you said earlier, so that they can have something after 10 or 20 years.
Yeah. Well, they're playing the game. They're playing the game that the government has set, right? It's, the old saying, don't hack the player, hack the game. They're using the resources that they have. They're learning about, understanding their finances and how it works in the property space to their advantage. And they shouldn't be punished for that. It's like, you're playing a game. It's like you're kicking a ball through a post, right? And you start off, takes you a while, you miss a few, whatever it may be, it takes you a while to get it. Then you start getting really good at it. And then it's like the government says, well, you know what, now we're just going to move this post further away. We're just going to make it harder for you, right? Again, to be fair, by then you've already kind of understand how it works and how to maneuver around it anyway. So if anything, it just causes an inconvenience, right? Does it actually fix the problem? Does it allow other people to get a shot in? Well, no, you probably just got to put more posts because you're just moving the posts further away from some people, right? It doesn't necessarily mean you're going to be moving it closer to someone else. So,
100%.
Yeah, 100%. It's just government capital gains, guys, is a tax that a percentage that you get to claim back on the gain of a property, right? And after 12 months, property investor, if he holds it for over 12 months, he doesn't have to pay 50% of the capital gain. He gets to pay 25%, technically 50% as a discount. Government is saying, let's get rid of this discount and let's just not give that to them anymore. Now, for me, that's just going to be fair, it's going to encourage me either to sell my properties now, right? For example, and then maybe invest into another asset. That's, again, probably something I'm going to hold long term, or it's actually going to make me want to not sell anything at all.
You're just going to want to hold. You just want to
Exactly,
grab as much as you can. I was going to hold.
I'm going to be like, well, now I'm less encouraged to sell the property. You know, I was listening to somebody the other day and it's like, yeah, okay, you buy property, you got to pay the capital gain. Gains is actually, you know, like, it's crazy. It's like they act as if it is going to be for the mum and dad, but who actually benefits? Government. They just get to charge you more, right? It's disguised as you know, something that's just not correct. That, you know, it's not what they're actually seeming to do. So as a property investor, I think more people are going to want to actually hold their property, right? Again, I think what you'll probably see is in the next period of time, up until they say either yes or no, you might see a couple panic sellers. Is that an opportunity for people? Absolutely yes. We're actually starting to buy properties right now that we think are cheaper than what they're actually worth, because it might get that little bit of a sugar hit to the market, a little bit of oversupply. Again, not a major, because the demand is so strong at the moment. Then prior to that, people are going to hold their property. They're going to hold it. They're going to hold it tighter than ever. So again, it goes back down to the government. Are they building enough homes? And they're not. So I think it could actually backfire.
Smart investors are already asking questions around structuring their portfolio for the long run. And as we know, if you were to buy a property in a company or trust with a corporate trustee, anything outside of your personal name, finance becomes an interesting part of the equation as well, because lending under legal entities or instruments is a little bit different than lending in your personal name. So on that note, do you have any advice for the investors out there that are considering this?
My biggest advice is, you know, structures are great and they have so many different benefits. The only real advice I would say is that, depending, for example, like Roy, we're purchasing properties to develop and looking at selling, right? And we've been advised by our accountant to, you know, set it up into a SPV, which is essentially a company structure, right? Whereas depending on what your purpose is for the property, depends on the structure. That's more my advice, is understand what your purpose is for each specific property, then go in with the structure that is going to be best suited for that specific strategy. That's more my advice around that. Be very aware about your constraints. Speak to a good broker about, you know, what type of lenders are out there for these specific structures as well. Yeah,
that's exactly what we did. Like we had a chat with the broker. We made sure that we can get a certain amount of deposit as a minimum benchmark, and then based on that, we reverse engineered it with the accountant if it can be possible to be set up, and then we hit the ground running. So it's very important to have the right vision, the right plan, have the right conversations with the right people, and then once you have all that in place, then you can execute relatively quickly.
Yeah,
absolutely, beautiful.
Yeah,
I think that wraps us up for today. I think it's a great introduction to the podcast, to us, and obviously we want to get in on the CGT conversation, which is, we managed to do that. So we'll push that out as soon as possible, and then we'll catch up again soon, and we'll have a chit chat about something else. Make sure you drop us a comment if there's anything specific you'd like us to talk about. Otherwise, we'll consider something that's interesting, and we'll come back to you on the next episode.